What's going on, guys? Welcome to another episode of the BJJ Lender, where we fuse financial strategies with the discipline and the mindset of Brazilian Jiu-Jitsu to help you grow. It's your boy Sham, and today we're going to be talking about bridge loans. No. I know what you're thinking. Financing construction with a short-term loan, it might seem risky, but for real estate investors, these loans can be a game changer, especially when you're moving fast to build or acquire property in a hot market. We'll look at what these loans are, the three key types, and why they are a powerful tool for your real estate journey. All right, so let's get started with the basics today. What exactly is a construction loan? Think of it as a bridge, literally. It's a short-term loan that gets you from point A to point B, whether you're financing the early stages of a construction project, securing a property quickly, or handling renovations. A bridge loan covers that gap between your permanent financing kicks in. These loans aren't designed to be long-term, y'all. They're meant for that critical window when you need fast capital. For real estate investors, that's an opportunity to snap up properties, get renovation funds, or break ground on new construction without waiting around for long-term financing. And unlike traditional loans, they're quickly to process and tailored for these specific situations. All right, let's get into three main types of bridge loans here, all right? Because not all bridge loans are the same. Each has its own advantages and ideal situations, depending on what stage you're in and what the project demands are. Number one, the traditional bridge loan. This is the one you're probably most familiar with. A traditional bridge loan is usually a short-term and backed by collateral, typically by the property itself. It's ideal if you need a bit of breathing room to refinance or sell the property quickly. The terms of these loans are straightforward, and you'll have access to funds without a lengthy approval process. It's also great for those who want simple, short-term solution without any frills. Next, we have hard money bridge loans. These are typically funded by private lenders instead of banks and are asset-based rather than credit-based. So, if you've got some dings on your credit, but the property itself has potential, this could be a solid choice. Hard money bridge loans often have higher interest rates because they're riskier for the lender. But the big advantage? Approval happens fast. When you're in a competitive market, this is the type of loan that can get you in the door before someone else does. Finally, there's mezzanine financing. This one's a bit unique because it's a blended debt and equity financing, often used when you're already running a business or managing several properties and need additional leverage. Mezzanine loans let you take out less initial cash, preserving capital for future projects or for unexpected costs. They're more complex, but for seasoned investors, they can be incredibly flexible. Now that we've covered the types, let's talk about why bridge loans are so beneficial for real estate investors. First up, quick capital. One of the biggest challenges investors face is needing funds fast. Bridge loans don't require the extensive underwriting of traditional loans, which means you can get approved faster, and in a competitive market, that speed can make or break a deal. Then, there's flexibility. Most bridge loans are short-term, so you aren't locked in for years. You have the freedom to exit the loan once you secure permanent financing or decide to sell the property. It's a temporary commitment for a temporary need. Finally, risk management. With fluctuating interest rates, locking into a long-term, high-interest loan can be risky. A bridge loan's short-term nature means you have more control over when you exit, reducing long-term risks. Before jumping into a bridge loan, there are a few things you need to keep in mind, all right? First, timing is everything. If you know you'll need long-term financing, have a strategy in place to transition from the bridge loan as soon as your project reaches a stable point. Also, be ready for higher interest rates because these are short-term loans and often approved quickly. The rates are usually higher than traditional loans. Make sure you're accounting for this in your investment plan. And finally, know when it's right for you. If you're buying and flipping properties at an auction, handling a quick renovation, a bridge loan could be perfect. But for longer-term investments, think carefully. Sometimes securing a standard loan up front makes more sense. So, Whether you're building from the ground up or renovating a property, bridge loans can give you the speed and flexibility to make your real estate vision a reality. They aren't for every project, but when used strategically, they're a powerful tool in the investor's toolbox. If you're considering your bridge loan, reach out to your boy or leave a comment below. Here at the BJJ Lender, we're about applying strategy, just like we do on the mat, to keep you moving forward financially and professionally. All right, guys, thanks for tuning in to another episode of the BJJ Lender. If you found today's episode valuable, don't forget to like, share, subscribe, and leave us a review in the comments below. Join us next time for more insights and strategies to help you reach your financial goals through real estate and investments and beyond. If you're looking for more personalized information for refinancing, check out the website, fortitudestrategicsolutions.com. And remember, like, share, subscribe, follow the Instagram, TikTok, YouTube channel at the BJJ Lender. With that being said, stay strategic, stay rolling, fam. It's your boy Sham. I'm out.